Silver is not just moving higher. Silver is moving into a zone where one more strong push could change the entire conversation around this metal. That is what happened. The market did not simply print another ordinary green stretch. It pushed silver deeper into a trend that more people are starting to notice, more traders are starting to chase, and more skeptics are starting to question. And that is exactly why this moment matters. Because when a market stops being ignored and starts becoming a story, the next move is usually not quiet. A lot of people right now are acting like the case is already closed. They are saying cheap silver is finished. They are saying the breakout is confirmed. They are saying the path to triple digits is basically open. And then on the other side, you have people rolling their eyes, calling it hype, calling it another emotional metals narrative that will end the same way these stories usually end, with a violent flush that catches late buyers off guard. Both sides are missing the bigger point. The real story is not whether silver is up. Everyone can see that. The real story is whether this market is building the kind of pressure that leads to a re-rating, or whether it is building the kind of pressure that leads to a trap. That is the question. That is the only question that matters. And if you get that wrong, the price will punish you either way. So in this video, we are going to strip the noise out of this story piece by piece. We are going to take the loudest claims, the cleanest narratives, the most repeated talking points, and we are going to test them the way the market tests every idea in the end, with pressure. Because silver is one of those metals that attracts conviction fast, but it also destroys lazy thinking fast. It can reward you brutally. It can embarrass you brutally. And right now, it is setting up for one of those moments where the next move will tell you who actually understands this market and who just got swept up in the momentum. Before we go deeper, drop the date you are watching this from in the comments. And while you are there, tell me one thing. Are you watching silver as an investor, as a trader, or as someone trying to understand whether this move is real? Subscribe as well, because the next phase of this story will not announce itself politely. Now let's start with the streak, because this is where a lot of the excitement begins. People keep saying silver has been stacking green months one after another, that it is building a rare run, that another strong close turns this into one of the most unusual momentum stretches in years. Broadly speaking, that is true. But the way people say it makes it sound cleaner than it is. A streak sounds powerful because it compresses complexity into one neat label. 10 green months, 11 green months. It feels decisive. It feels like the kind of number that proves something. But markets are not that generous. A streak does not tell you how much effort the market needed to maintain that streak. It does not tell you how close the market came to losing it. It does not tell you how much leverage piled in underneath it. And it definitely does not tell you what kind of selling pressure could hit the second the rhythm breaks. That matters, because silver has never been the kind of market that climbs in a straight line and politely rewards everyone who notices. Silver is volatile by nature. It is emotional by nature. It attracts strong opinions, aggressive positioning, and sudden reversals. So yes, a streak is real. But the conclusion people attach to the streak is where the danger begins. A streak is not a promise. A streak is not protection. A streak is just evidence that momentum has been strong so far. That is all. And when a market gets described too confidently, that is usually your first warning sign. Now attach that streak to the second big talking point, and the narrative gets even more explosive. People say China is showing a higher silver price. They point to Shanghai. They talk about a premium. And then they jump immediately to the conclusion that the Western benchmark is wrong, that the East is discovering the true price, and that global silver is about to snap violently upward to catch up. That sounds great. It is also not that simple. A premium in one market can absolutely matter. It can reflect stronger immediate demand. It can reflect tighter local supply. It can reveal stress. It can reveal urgency. But it does not automatically mean the whole global market must instantly reprice to that level. Markets are separated by frictions. They are separated by shipping. They are separated by contract structures, regulations, taxes, access, timing, and capital movement. A local premium can be important without being a magical signal that everything else is about to teleport higher overnight. And that is where too many people stop thinking. Because the real question is not whether a premium exists. The real question is why it exists. Is it structural? Is it temporary? Is it driven by durable industrial pull? Or is it driven by local bottlenecks that can unwind as quickly as they appeared? Those are not small differences. Those differences are the entire game. If the premium is telling you that global silver is entering a new regime, that is one kind of story. If the premium is telling you that one region is dealing with near-term stress, that is a completely different story. Most people online do not want that level of nuance. They want a clean slogan. They want leader, follower, breakout, explosion. But markets usually punish clean slogans. They reward patient interpretation. And while everyone is staring at that premium, something else is happening in the background that may matter even more. The futures market itself is becoming a bigger part of the story. Liquidity, positioning, margin pressure, technical disruptions, rule changes when things get too hot. That is where silver gets dangerous, because silver does not just move on supply and demand. It also moves on the conditions of the battlefield where price is expressed. This is why those massive price targets need to be handled with care. You hear silver to triple digits. You hear silver to the low hundreds. You hear even more extreme numbers thrown around like they are already waiting around the corner. But a forecast is not a fact. A target is not a destiny. A price projection is just a scenario with assumptions hiding underneath it. For silver to move into that kind of zone, what needs to happen? That is the right question. Not whether the number sounds exciting, not whether the chart looks good. What has to happen in the real world for silver to keep climbing without destroying itself on the way there? Because silver does not rise in a vacuum. Silver rises through conditions. It rises through weaker confidence in paper assets. It rises through demand for hard assets. It rises through industrial pull. It rises through tightening supply. It rises through investor fear. It rises through capital rotation. And it rises through narrative momentum. But those conditions can strengthen together or break apart suddenly. That is why the path matters more than the headline number. Gold helps tell part of this story. Gold has not just been drifting. Gold has been asserting itself. It is acting like an asset people want when trust gets shaky. It is acting like a reserve escape hatch. It is acting like confidence insurance. And silver, unlike gold, sits in two worlds at once. It carries that monetary shadow, but it also has a factory job. It gets consumed. It gets embedded. It gets used in systems that do not care about internet debates. That gives silver a second engine, and sometimes that second engine is exactly what makes the move so violent. But that second engine is also why silver can be cruel. Because industrial demand has cycles, manufacturing has cycles, speculative flows have cycles. So when the market gets nervous, silver can outperform on the way up and underperform on the way down. That is why silver is seductive. It promises torque. It delivers torque. And torque works in both directions. This is where the gold-silver ratio debate enters the conversation and confuses people all over again. You hear that silver should be here because the ratio should be there. You hear that if gold is at one level, silver is mathematically supposed to be at another. But the ratio is not a law of nature. It is not gravity. It is not physics. It is a moving expression of how the market values two different stories at the same time. Sometimes gold is treated as pure protection, and silver is treated as a messier, more cyclical cousin. Sometimes silver gets embraced as the more explosive version of the precious metals trade, and the ratio compresses hard. Sometimes it stretches. Sometimes it snaps back. But saying silver must go somewhere because of a ratio is just another way of saying you want the market to accept your preferred narrative. That is not analysis. That is preference wearing a suit. Now let's talk about exchange stress, because this is where the narrative starts getting more dramatic. Technical halts, outages, interruptions, sudden market dysfunction. People see these episodes and they immediately connect them to upside. They say the exchange breaks, confidence breaks, price explodes. Maybe, but not automatically. Stress can produce upside. It can also produce chaos, wider spreads, forced liquidation, tighter rules, and a faster flush than anyone expected. We have already seen that when markets get too wild, the authorities do not just sit back and watch the fireworks. Margin rules can change. Risk parameters can change. The cost of staying in the trade can change instantly. And when that happens, leveraged players do not get to philosophize. They have to respond. They have to post collateral or exit. That forced selling can hit even in a bullish structure. This is one of the most misunderstood parts of silver. People think if the long-term case is right, the short-term path should cooperate. That is not how silver works. Silver can crush the weak hands on the way to proving the strong hands correct. It can deliver the right ending through a very painful middle. So when people tell you silver is obviously going much higher in the next few weeks, that may happen. But the hidden condition is that the market must survive its own volatility without shaking too much capital out of the tree first. Now we need to deal with the phrase that keeps getting repeated everywhere, the end of cheap silver. Because that phrase is powerful, but it is slippery. Cheap relative to what? Relative to gold? Relative to money creation? Relative to industrial demand? Relative to mine economics? Relative to electrification? Relative to history? You can make silver look cheap or expensive depending on the ruler you choose. But there is something real inside that phrase. It is this. The old assumptions around silver are being challenged. Not by one dramatic announcement, not by one exchange glitch, not by one premium, but by a stack of pressures that keep building. Industrial usage is not a side note anymore. Strategic relevance is not a side note anymore. Investor attention is not a side note anymore. And when those things start overlapping, the market begins to behave differently. That does not create a guaranteed floor. Markets do not give guaranteed floors, but it can create a behavioral zone where buying interest starts showing up more aggressively than it used to. Producers adapt, recyclers respond, industrial users start thinking differently. Investors who ignored the metal start paying attention. Governments start noticing that silver is not just decorative metal, it is part of the machinery now. In that sense, yes, the environment changes, but do not turn that into fantasy. A behavioral floor is not an unbreakable floor. If liquidity disappears, if leverage gets squeezed, if a broader risk-off event hits, silver can absolutely break lower. It has done it before, it will do it again. That is why conviction in silver has to be paired with humility. Otherwise, the market will teach it to you the expensive way. Now let's get to the supply and demand piece, because this is where the story becomes harder to ignore. When people hear the word deficit, they imagine a shelf going empty. That is not how this works. A silver deficit usually means total demand exceeded newly mined and recycled supply, and the difference was absorbed by above-ground inventories. That can go on for a while. It does not need to produce a dramatic out-of-stock moment immediately. But repeated deficits matter, because inventories are not one giant pile waiting politely for sale. Some silver is locked away. Some is in products. Some is in vaults owned by people who do not care what the short-term chart is doing. Some is technically there but practically unavailable unless price rises enough to pull it loose. That is what tightness really means, not total disappearance. Reduced willingness to part with the marginal ounce. Think of it this way. The market does not need to run out of silver for price to react violently. It only needs to realize the easy silver is not as easy as it thought. And on the supply side, the situation is even trickier than most people understand. Silver is not produced in a clean, simple way. A lot of it comes as a byproduct of mining for other metals. That means even if silver prices rise, supply does not automatically surge in response. You cannot always flip a silver switch. You may need a copper expansion, a zinc expansion, a broader project build-out, new permits, new capital, new time. Demand can move fast. Mine supply usually moves like it is dragging chains. That is why tight markets stay tight longer than people expect. And then there is the industrial story. Solar, electronics, electrification, data infrastructure. Systems that use silver not because it is trendy, but because it works. That is a different kind of demand than speculative attention. It is slower to appear, but harder to wish away once it is embedded. And when industrial strength overlaps with investment interest, silver becomes uniquely unstable in the upside direction. Not stable. Not safe. Unstable upward. That is what people are trying to describe, often badly, when they say something huge is coming. Now let me challenge the hype crowd for a second. You should not want the market to stop functioning. You should not want a breakdown in trading itself. If pricing venues become unreliable, if rule changes start flying, if spreads widen, if transacting becomes harder than quoting, that is not a healthy bull market. That is confusion. That is friction. That is a market where the number on your screen and the price you can actually do business at start to part ways. Real repricing is powerful enough. You do not need dysfunction to make the bullish case. So what should you actually watch from here? Watch volatility first. Not just direction, volatility. Because volatility tells you whether the market is repricing in an orderly way or whether it is becoming more fragile as it rises. Watch how dips behave. In a strong market, pullbacks get absorbed. In a weak market pretending to be strong, rallies are sold faster and buyers hesitate. Watch whether nearby stress starts showing up in the curve, in premiums, in urgency for immediate supply. Watch whether people who need silver are adapting calmly or starting to pay up. And most importantly, watch behavior, not slogans, because that is the final point. This market is not about a single magic number. It is not about one ratio. It is not about one premium. It is not about one technical issue. It is about the interaction between industrial demand, investor psychology, available supply, leverage, and the rules of the marketplace itself. That is the chessboard. Everything else is commentary. So is silver about to do something huge? It might already be in the process of doing it. Not because everyone online is chanting the same target. Not because one region printed a premium. Not because one streak sounds historic. But because the old reference points are getting weaker, while the new pressures keep stacking. That does not guarantee a vertical move tomorrow. It does not guarantee triple digits by the end of the month. It does not guarantee a smooth ride. But it does mean the market is entering a zone where dismissing silver as just another sleepy metal starts looking more and more irresponsible. And that is when the biggest moves usually begin. Not when everyone agrees. When the old framework starts failing in public. So now I want your view. Is the Shanghai premium a real leading signal, or is it a temporary pressure point people are exaggerating? And what drives the next major leg higher? Relentless industrial demand, or investors suddenly rushing back into safe haven assets? Drop your answer below. I want to see where you stand. And one more thing. Do you think silver sees triple digits before this month is over? Or does volatility wreck that timeline first? Tell me what would change your mind either way. If you found this useful, subscribe now. Stay close to this market. The next twist matters more than the last headline. And remember, the perfect moment never arrives looking perfect. It arrives looking noisy, uncomfortable, and easy to doubt. That is usually how real moves begin.